Odie, Jacob here. Today we're looking at DLH Holdings in the professional services industry, 143 million market cap, and actually double that for enterprise value. And their insider ownership is currently 12.5%. So that's going to make you feel a little bit better investing in this business where 12.5% of it is owned by the board, management, CEO, CFO. They're likely going to make decisions that are best for you as the investor because they themselves are heavily invested. We actually see pretty big growth from 2014 to 2023. However, the most recent year actually held a decline. Interestingly enough, there was only one other year. There was 1 year in the last 9 years prior where it grew 8%. Everything else was well into double digits. Gross margin and operating margin are okay, 20%, and then operating margin is 7%. They are increasing though, which is positive. Return on invested capital historically is mid-single digits, but it's been as high as 47%, as low as 0.7% the most recent year. So they don't have any research and development. A hefty amount of their expenses are going to be cost of goods sold. And then they've been growing a lot, which you can see through revenue, as well as their sales, general, and admin jumping up almost 5 times. Their balance sheet has no cash on hand, less than $1 million of cash, with 17 million short-term debt, 155 million long-term debt. That's a concern. So it looks like they just made an acquisition in 2023, which we can see through their other intangible assets and goodwill increasing as much as they did. And their cash flow statement, they do produce a hefty amount of free cash flow with very little capex. Their investments are entirely based on acquisitions. There's essentially no other form of capital allocation. Maybe a little bit of debt reduction, but they also issue quite a bit of debt when they fund these acquisitions. So I think it's easy enough to get to some assumptions. When you grow, they are growing a lot. They are making a lot of acquisitions. I think that they can grow at 8% a year with those acquisitions. However, I think that one, it's a small business, so I want a little bit extra return. Then two, it's market average PE. However, I'm going to actually lower that again because their EV is double their market cap. So maybe I'm going to give them a 13p price to free cash flow. And again, I'm having an extra discount rate because of the amount of debt they have and their enterprise value being so much greater is a bit of concern of mine. And their funding of or their capital allocation being all acquisitions. If you're very efficient with it, it can really increase business, but I'm always skeptical about it. Organic is almost always better in my perspective. So when you get to margins here, free cash flow being so much higher definitely makes me feel a little bit better. And the share change, I'm going to have to look at their historical. I'm going to look at their historical price to earnings and price to free cash flow because right now, okay, so I mean, it's just a cyclical business at this point. So price to free cash flow is a bit more consistent. And so recently been very low. Okay, interesting. But they did recently just go into quite a bit of debt, 135 million debt to fund this acquisition. So before investing in anything, even if it looks like a great deal from this perspective, which from here, I mean, 2 million increased 2%, it looks like a good deal, 16% above where I would buy it given these assumptions. But the realistic perspective is that one, can these assumptions hold? I don't know. That's why you're going to have to do a deeper dive. I'll try to do a deeper dive soon, but I try to be a bit on the conservative, or I try to be as conservative as possible with what I know. And here, I think my biggest concerns would be growth rate. If they grow through acquisitions, I think 8% is fine. These margins, I'm a little skeptical of since they definitely haven't done that on the earnings side, and their free cash flow margins are actually going down. So that's a bit concerning to me. Maybe I'll do 4 and 6 because they're declining on the free cash flow side. Not a big fan of that, but even still, it's pretty darn close. So I will try to do some more research on this. Again, this is just one perspective. It gives you what you think the business is worth based on free cash flow and earnings. But what you can't necessarily put into here is the balance sheet. And so again, They do produce a good amount of free cash flow. Let's say generously 25 million. They have about a little over 6 times that in long-term debt, but they don't have any cash. So that if they had one bad year, they're going to have to go into debt, and they don't have the capability of paying this down. So, I mean, the no cash on hand is a concern. There's also some other concerns with that balance sheet. So, although it's saying it's pretty darn close to a buy, or maybe your assumptions are saying it's a buy, balance out with the balance sheet with this. And sometimes, at least in my perspective, I've said no because the balance sheet is bad enough, and I'm going to wait until management does what I think is best for the company. And if they don't, I don't buy it. Simple as that. Hope you enjoy the video.